Dell Technologies is benefiting from the rising effectiveness of artificial intelligence and the insatiable demand to build new data centers optimized for AI. The company is in greater focus following growing concerns for one of its rivals, Supermicro, which is the subject of a short seller who is claiming that Supermicro is misreporting its financial results. Nevertheless, Dell reported an excellent quarter in its segment that serves the AI market, which I will discuss in greater detail in this video. Also, I will update my recommendation of Dell stock and let you know if the stock is a buy at current valuations. I'll do all that in this brief video, so let's get into the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So in its latest quarter, which ended on August 2nd, 2024, Dell reported net revenue of $25 billion, which was up 9% from the same quarter the prior year. In the first 6 months of 2024, Dell's results are up 8% year over year. In the latest quarter, operating income jumped by 15% to $1.34 billion, and that was up more than the 1% for the full year so far in 2024. One area of concern was Dell's adjusted free cash flow, which was down by 58% to $1.284 billion. And the same is true for the first 6 months of the year. Its adjusted free cash flow is down 49% year to date. Interestingly, its rival Supermicro has reported negative free cash flow or negative cash flow from operations for several consecutive quarters. And I've noted that's okay for a company and the segment that's growing rapidly. And I'll share that with you with Dell and detail why the cash flow is falling or why the cash flow is decreasing. Also, there was a huge increase in cash flow in the same quarter last year. And so in this year, it's more difficult to compare against that cash flow number. But more precisely, it's the rapid growth that's causing cash flow to fall or decline. And while that might seem counterintuitive, I'll explain why that's the case. But first, let's look at the segments within Dell's business. Dell has two separate business segments, and one segment serves the personal computer market or the business computer market, and the other segment serves the server market or enterprise servers. Within that segment is the AI server market, and that's the segment that's thriving for Dell. And it's called the ISG Infrastructure Solutions Group, which delivered record revenue of $11.6 billion, which was up by 38% year over year. Servers and networking revenue was a record $7.7 billion, which was up 80%. With demand growth across AI and traditional servers. The management saying that our AI momentum accelerated in Q2, and we've seen an increase in the number of enterprise customers buying AI solutions each quarter. AI optimized server demand was $3.2 billion, up 23% from the previous quarter, and up $5.8 billion year to date. They've also got a backlog of $3.8 billion, and their pipeline has grown to several multiples of our backlog. So this segment is absolutely thriving, and you've seen this, and I've seen this across the category, whether it's Dell Technologies or Supermicro or Hewlett-Packard Enterprises. This segment is absolutely thriving, and NVIDIA has reported continued success, and NVIDIA's solutions are the main driver of demand for AI optimized servers, which companies like Dell and Supermicro help integrate and install. NVIDIA delivers the inputs, and then Dell helps install them, integrate them, and connect them, put it all together. And so Dell is benefiting significantly from that demand. Another area of concern is the falling profit margin. Now you could see operating profit margin for Dell in the quarter that ended August 2nd fell to 11%, down from 12.4% in the same quarter last year. And that's true for the first 6 months of the year as well, with operating profit margin falling to 9.7% from 11.1%. The main reason for this is growing competition. I highlighted a couple of the competitors, Supermicro especially, has noted that it's aiming to grow its market share, and it's offering attractive terms and pricing to customers to gain market share. And so this industry overall is already not a very high profit margin industry, but it's declining because of the rising competition started by Supermicro Computer, which is really trying to take market share in this segment in the early days. And so that's driving down profit margins industry-wide. So now let's get to cash flow. And I mentioned already I would go into a little bit more detail as to why the company's cash flow is declining. And this is common for companies like Dell that work with hardware mostly, and they experience growth because they first need to get the hardware, get the inputs, get the inventory, put it all together, sell it, and then they get their money back sometime later. And so when you're growing rapidly, your accounts receivable are growing faster from the newer sales than you're getting from older sales. And accounts receivable changes your cash flow. Accounts receivable changes your cash flow because that's money coming in or money not coming in. If you make a sale, you get payment immediately. That's money coming in. If you make a sale and you let the company owe you to pay you back 3 months later, that's an accounts receivable. And you'll notice Dell's accounts receivable jumped from February 2nd, 2024 to August 2nd, jumped by over $2 billion to $11.39 billion from $9.34 billion. And that's a direct result of the growth of the business and offsetting that with accounts receivable becoming lower in previous months and higher now because its sales are higher. And so accounts receivable are higher than they were 3 months ago, 6 months ago. And the same is true for inventory, which was also up by over $2.3 billion to $5.95 billion, up from $3.6 billion. And the same is true for inventories. When you're growing much quicker than you were previously, you're building up more inventory to serve growing demands. And so you're holding more inventory at this point in time, August 2nd, than you were on February 2nd because you're anticipating growth. Now, that's not always the case. Sometimes companies get stuck with more inventory because they thought they were going to make sales, but they didn't make those sales, and so now they're stuck with inventory. That's not the case here. This is the case where Dell is anticipating record demand, and so it's building up inventory, getting ready to serve that demand. So it's a good increase in inventory, whereas the previous case would be a bad increase. So I highlighted that I did not have Dell stock rated as a buy. In fact, I had downgraded. I told investors to take profits in Dell stock, and I updated that on May 30th. And it just so happened to have been great timing because Dell stock, you could see it peaked around May, end of May, here at over $175 per share before falling all the way down here and now rebounding to $115 per share. But the reason I downgraded Dell stock and told investors to take profits is not because the market price was reaching record highs, but because the valuation was reaching really astronomical levels that had not been reached before for Dell Technologies stock. It reached a forward price to earnings ratio close to 20 when this stock was not trading at a forward PE over 10 for several years. And so this increased valuation was cause for concern, and that's why on May 30th, I told investors to take profits in Dell stock. However, now the valuation is down to 12.2, which is a more reasonable valuation given the company's prospects and given the breakdown of its revenue now. It's more of a 50-50 split between the infrastructure business and the client services business, which is not as attractive, not expecting growth there. So given that the valuation is more attractive at a forward price to earnings of 12, and given the prospects are improving for Dell Technologies, especially in that server group and seeing growing, accelerating demand for artificial intelligence, I'm going to upgrade Dell stock here from a hold. I'm going to upgrade it one notch to a borderline buy following these financial results, and I'm updating that recommendation on September 2nd. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? hit that subscribe button, and I'll see you again soon.